Hello everybody and welcome to this video on chapter 12, which is all about a new financial statement. We've already learned about the income statement and the balance sheet, and we'll still be talking about them today, but I want to talk to you guys about a new statement called the Statement of Cash Flows. And this tells us some other interesting information that is very helpful to businesses that the income statement and the balance sheet don't quite tell us. So even though those other statements tell us important information, it doesn't tell us everything. So we need this third financial statement to give us some more information. Now, before we begin, I want to talk about the difference between making money and cash flows. And we've touched on this several times throughout the class, but this is a very key concept in accounting and in business that is important for you to understand. Now, making money refers to revenues minus expenses, which equals net income. Okay? It's not the same as cash per se. Okay? Revenue is providing goods and services, and expenses are using goods and services to produce revenue. And yes, at some point, the revenue, we will collect cash for it. And with expenses, yes, at some point we will pay cash for it, but it doesn't always happen at the exact same time. So that's why making money is not necessarily the same as cash. Okay? So if we want to know how much money we made, the way that we find that out is by looking on the income statement. Okay? But the income statement doesn't tell us how much cash we got or how much cash we spent, because like we said, making money is different than cash flow. So that's where the statement of cash flows is necessary, because some revenues are not in cash. And that's what accounts receivable is. It's where we've provided goods and services, so we've earned revenue, but we haven't collected the cash yet. It's a receivable. Okay? Also, some expenses are not in cash, right? Maybe we use something, but we haven't paid for it yet. And that is what accounts payable is. And there are other examples of timing differences that we talked about that all had to do with the adjusting entries that we learned in chapter 3, but there are many instances in accounting where a revenue or expense happens at a different time than the cash is either paid or received. Okay? In addition, there are other things that bring in or use cash besides revenues and expenses. So there are things that bring in cash or use cash that you don't even see on the income statement at all. For example, when you buy long-term assets, that's like your equipment, your building, your machines, your vehicles. When we buy those things, we don't see them on our income statement at all. So but it is a cash flow item, right? You require cash to buy those things. Another example is borrowing money. When you borrow money, when you go to the bank and get a loan or whatever, you don't see that on the income statement. It has nothing to do with making money. So, but it involves the cash flow, right? There's cash coming in when you borrow the money. There's cash going out when you repay it. Same thing with common stock. When you sell common stock, you don't see that on the income statement. It's not an element of revenue or expense, but you get cash for it. So these are things that we need to consider in our statement of cash flows that you wouldn't necessarily see on the income statement. So what the statement of cash flows tells us is which activities bring in cash and which activities use up cash. And we categorize the activities of a business into 3 types of activities: operating, investing, and financing. And these are the 3 sections that you're going to see on the statement of cash flows. There's an operating cash flow section, an investing cash flow section, and a financing cash flow section. So what goes into each of these categories? Well, let's start first with operating activities. Okay, the term operating refers to what a company does to make money. So that has to do, again, primarily with revenues and expenses. The things that they sell, the products and services they provide, and what they use up in order to provide those products and services. So most of that is what you're going to see on the income statement, because making money, again, is revenues minus expenses. And in fact, another name for income statement is statement of operations. So there you see that word operations again. It's referring to the normal operations of a business, what they do to make money on a daily basis. So to get clues for what kinds of things go on operating activities, the first place you look is the income statement, because that's where you're going to see revenues and expenses. But as we discussed, there are also timing differences related to revenues and expenses versus the timing of cash, when you receive and pay cash. So for those timing differences, you got to look on the balance sheet. So those are going to be accounts like accounts receivable, right? Where we've earned revenue but haven't received the cash yet. Or inventories, where maybe we've paid cash but we haven't sold the goods yet, so there's no expense of cost of goods sold. Supplies, right? Supplies are, we paid the cash for them first, but we don't have the expense until we use them. So we're waiting to use them. Prepaid expenses, right? Where we pay for something in advance, like insurance, but it's not an expense until we use it. So the cash flow happens first, but we use it later. Okay, let's also talk about on the other side, accounts payable, right? That's where we've used something first, but we haven't paid it yet. So the cash is going to happen later. Also, wages payable, right? We've used our employees' services first, but we're going to pay them later. If you guys need a refresher on any of these accounts, I encourage you to go back to chapter 3 and review that, because that's where all of these different things are discussed, all of those adjusting entries. So for those revenue and expense items where the cash happens at a different time, we need to also look at the balance sheet for these specific accounts. So you could kind of say the area of the balance sheet you would look at, if you notice, all of these are considered current assets. And we talked about what current meant when we were doing chapter 9. But these are all current assets. And when I say operating assets, meaning the current assets that have to do with the operations of the business, right? The normal things that the business does. And same thing with current, you notice these here, accounts payable, wages payable, there's other payables we've talked about, but those are current liabilities. But we want to focus again on operating liabilities, meaning the current liabilities that have to do with the normal operations of the business, just those timing differences of revenues and expenses. Okay, there could be maybe some other current liabilities that are not necessarily operating in nature. So for example, if you borrow money for a short-term note, that would not be considered operating. We'll talk about what that is a little bit later, but it's not operating. So really just focus on only those current assets and current liabilities that have to do with the normal operations of the business. Okay. Okay, so some examples of operating cash flows, what primarily brings them in and takes them out. Because we're talking about revenues, what brings in the cash is when we receive cash from our customers. That adds to our cash. It's a positive operating cash flow. And what decreases our cash or uses up our cash are when we have to pay our suppliers, our employees, our landlords, so on and so forth. Those are things that cause a negative operating cash flow. Now let's move on to the second category, which is investing activities. So we talked last class about what the term investment meant. Okay, an investment means putting money into something to get a return, to make more money. And we talked about it last class in the context of stocks and bonds. Okay, that investors invest in stocks and bonds and they hope to get a return back through, the business making money or through interest and things like that. But that was more for like individual investors, and certainly companies can also invest in the stocks and bonds of other companies, which should also be considered investing activities. But primarily, what does a company invest in? Well, they invest in plant assets. Okay? They buy buildings, they buy equipment, they buy machines, they buy vehicles. And the hope is that they're going to put their money into those things and use them to get a return, use them to make more money in the future. So investing activities primarily consist of plant assets. And where are we going to find those in our financial statements? Well, we're going to find them on the balance sheet in the long-term asset section. So if you look there, that's where you're going to find clues as to what your investing cash flows are. Okay? So investing activities involve anything really related to those long-term assets, those plant assets. So if you buy a plant asset, well, that's going to decrease your cash flow. That's going to be a negative operating cash flow. A negative investing cash flow. And also, though, if you sell those assets when you're done with them, that's going to bring in cash. So that's a positive investing cash flow. So anytime you're buying or selling those plant assets, that's going to be considered an investing activity. Now, last we go to financing activities. And last class, we learned what that term financing meant. It meant how a business gets cash for like a big project. If they want to, build a new factory or, buy another business, or like the government, if they want to, build a school or build a freeway or something like that, they might issue bonds like we talked about. But financing, if we're talking about how we get cash, right, which is here, there are two ways to get it we talked about, right? It's either going to be through borrowing it, which is liabilities, or bringing in more investors, which is equity. Okay, so where we're going to find clues for financing activities are going to be also on the balance sheet, but we're going to look in the section for liabilities, really long-term liabilities, which are going to be those cash transaction with creditors. And we're also going to look in the equity section of the balance sheet, which is our transactions with owners. So like things like common stock. When we sell common stock, cash is coming in. Or then when we pay our owners, which is dividends, that's going to be a cash transaction. Okay? So examples of cash flows from financing activities, when it comes to liabilities, we're talking about when you receive a loan, you're going to bring in cash. And when you repay the loan, that's going to decrease your cash. On the equity side, when you issue stock to your owners, you sell the common stock to the owners, you're going to bring in cash. And when you pay dividends, that's going to use up cash or be a negative cash flow. Now, real quickly, I want to talk about how the financial statements link to cash flows. So when you look at these financial statements, you'll see that you can look at the financial statements to get clues for the different types of cash flow activities. So the income statement is primarily going to be operating cash flows because it's revenues and expenses. For your balance sheet, your current assets and current liabilities are going to be primarily operating cash flows because they have to do with those timing differences with revenues and expenses. And for your long-term assets, your property, plant, and equipment, that's going to be primarily investing activities. And then for your long-term liabilities and equity, those are both going to be financing activities. So that's a quick way to link those financial statements to the statement of cash flows because we're going to use the income statement and balance sheet to prepare our statement of cash flows. Now, an important tip that I will share for you in the next video.